Vanakkam, Namaskar, and hello to all the viewers and listeners of this edition of Fixed Income Markets with Sundaram Mutual Fund. The month gone by has been marked by data which has surprised the markets positively, starting from the GDP number for FY24, which came at 7.3% versus 6.7% expectation, largely on back of government investments and consumption. The CPI for December 23 came at 5.7% versus market expectation of 5.9% on back of vegetable price rise, and the core for the first time moderated to 3.9% below 4%. Globally, we have seen a moderation in inflation numbers across the developed economies on account of moderating goods and commodity prices and stable energy prices. In the US, the personal consumption expenditure has moderated below 3%, a measure favored by Federal Reserve and is expected to further moderate. Federal Open Market Committee meeting held on 31st January gave an anticipated verdict of status quo on federal fund target rate, but the language used in the accompanying statement delivering the verdict seemed less harsh, as FMC dropped the case for further raising the rates and reiterated that tighter credit conditions are weighing on the economy, but maintained the resolve to bring inflation down to 2% target and continue with balance sheet unwinding in the current phase. Powell stated that in the next meeting they will have a detailed discussion on balance sheet unwinding, a hint to probably lower the pace of unwinding. However, Powell ruled out any rate cuts in upcoming March meet. In China, the People's Bank of China resorted to address the stress in the economy by supplying liquidity and cutting the reserve ratio by 50 basis points instead of cutting the medium term lending rate. This has been the stance of PBOC, maybe seeing the futility of zero rates in other economies. As of now, it looks like Chinese economy has a long way to go before it stabilizes. Back in India, the interim budget was a pragmatic one, devoid of any populism, particularly in light of the upcoming general election, and filled with fiscal prudence, a necessity when the debt to GDP ratio has been rising from FY23 level of 83.5% to probably around 85% in FY24. With inclusion in global bond indices, a desirable character is of fiscal rectitude. Having said that, the numbers look credible when we anchor them to the current economic environment and expect same or better environment going ahead. In case any slowdown in economy happens, the tax buoyancy is likely to fall, as the GDP deflator this year is likely to be more realistic on account of our tilt to WPI, which is wholesale price index, which is likely to be in positive territory this year. We don't think that government will not be able to meet the fiscal deficit, but we can expect cut in expenditure, and in case the private sector does not pitch in as expected, overall numbers can be lower, tilting the spending in favor of lower multiplier revenue expenditure. Although the surprise on the government in terms of faster fiscal consolidation, if FY24 5.8% of GDP versus 5.9% budgeted, and itself a much sharper one in FY25, 5.1%, a lot depends on how the year progresses. We still believe that in a growth starved global economy, India growth was heavily lifted by the government, and in case of led counter-cyclical play by the private sector can result in path of fiscal consolidation being a difficult one. At least the growth impulse can be challenged. In the upcoming Monetary Policy Committee meeting, we believe the committee will maintain a status quo both on rates and stance as long as the growth is relatively strong and inflation does not align below or at 4%. We expect the RBI to maintain a neutral tone, acknowledge the moderating inflation impulse, and applaud the fiscal prudence the budget gives legs to its stand of actively disinflationary policy. Liquidity is likely to be moderated depending on the government cash balances and inflationary impulses in the economy. In this background, we continue to recommend the savvy investors who can time the market to take exposure to longer duration funds, namely gilt funds, long duration funds, etc. We at Sundaram do not have these funds. Otherwise, we recommend for investors with 18 to 24 month horizon to remain deployed in mid duration funds, namely short term funds, corporate bond funds, banking and PSU funds, etc. While for cash management, the investor can continue to use overnight, liquid, and ultra short funds. Thank you and see you in the next episode.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.